Welcome, everybody. This is Ellman, the Blue Collar Investor, and this is BCI podcast number 66, titled Comparing the Cost to Close with Initial Trade Goal with Covered Call Writing. We're going to be using a real-life example with Facebook Inc. that trades on the New York Stock Exchange, on the NASDAQ Stock Exchange, under the ticker symbol FB. Let's start off this podcast by first defining a few terms. What is an initial time value return goal range? Well, simply stated, before we enter any trade, we have to know what our objective is. What is our goal? Now, when we're selling options, we're generating premium. So we're looking to generate a regular cash flow by selling options. What are we looking to generate? In terms of our investment, what is our percentage return goal, at least from an initial structuring perspective? Well, to do a percentage then, what we do is we take the time value of the premium, whether it's an out of the money, at the money, or in the money strike, and divide it by the lower of the stock price or the strike price. So if we sell an at the money or out of the money strike, then we're dividing it by the price of the stock. For at the money, they're both the same. But when we write an in the money call, we're dividing the time value initial return by the strike price, because we use the intrinsic value to buy down the cost of the stock. Okay, so we take the time value and we divide it by the lower of the stock price or the strike price. And then we determine what time frame. Are we selling weekly options, monthly options, somewhere in between, longer term options? In my case, I prefer monthly options. And my goal is 2 to 4% a month for near the money strikes for my initial time value return goal range. And that applies both to in the money and out of the money strikes. Next, let's define the time value cost to close. In this particular case, we're not rolling the option, but we've made a decision to close both legs of the covered call trade. We're going to close the short call, buy to close, and we're going to sell the stock. We're going to completely close the trade before expiration. Now, the time value component of the premium, the premium that we have to pay to close the short call, consists of intrinsic value and time value. So time value is the total premium minus the intrinsic value. Let's set up a hypothetical example. Let's say BCI is trading at $60. Now, assuming the $50 call was originally sold, what would it cost to buy it back? Well, we know that the $50 call has $10 of intrinsic value, because that's how far the 50 call is below current market value of 60. Plus, there's going to be some sort of a time value component. In this particular case, 10 cents. So the entire premium is $10.10. But only 10 cents of that is time value, which is what we must focus on. So the intrinsic value is $10, time value is 10 cents, and now the cost basis, since it's an in-the-money strike, would be the strike price of 50. So the time value cost to close then translates to 0.2%. If we were considering doing this, closing the trade mid-contract, we would then ask ourselves, can we generate more, 1% more than the time value cost to close? In this particular case, 1.2% or more by contract expiration. If the answer is yes, then we go ahead, we close both legs of the trade. Now let's look at a trade that Mazen sent me with Facebook in June of 2019. On June 5th, Facebook was purchased at $165 a share. The at the money June 28th, so 23 days later, was sold at $5.92. So that was the initial structuring of the trade. We'll feed that in to the Ellman calculator to get percentile returns, but basically that's how the initial trade was structured. Now, 14 days later, on June 19th, Facebook had shot up in value to 181.92. Would it pay to close the 165 call? And if we took a look at an option chain, we would see that the ask price, remember, if we buy to close, we'll buy at the ask, was $24.36. Seems kind of expensive, but we're going to break it down. Let's first have a look at how Mazen structured his initial trade. Remember, this is a 23-day return. So Facebook purchased at 165. The at-the-money 165 call was sold for 592. That represented a 23-day initial time value return of 3.6%. No chance of any upside potential because we're agreeing to sell it for the same price it's currently trading. So if the price moves higher, we do not participate in that additional share appreciation. Now, downside protection of that time value return is zero. Right? That would be represented only if it was an in-the-money strike in the form of intrinsic value. But there's always a break-even. Every covered call trade has a break-even. And that break-even is the price of the stock, in this case 165, minus the entire premium, in this case 592. So our break-even price is 159.08. So that's how the trade was structured, a 23-day initial time value return of 3.6%. Now, should we close mid-contract, or should we wait closer to expiration to see if we should perhaps roll the option if the strike is still in the money by contract expiration? As of this date on the 19th, it's deep, deep in the money. Okay, so we go to the Unwind Now tab of the Elite Plus calculator. We enter the information. Facebook purchased at 165, and the 165 strike sold at 592. Today, the price of Facebook was 181.92, and the cost to buy back that 165 call was up to 24.36. Now, once that information is entered into the blue cells of the Unwind Now tab of the Elite Plus calculator, the white cells on the right side of the spreadsheet become populated. Now, for those of you who have this spreadsheet, you want to focus in on the very bottom right of that spreadsheet on the right side, and it will tell us that the cost to close, the time value cost to close, is $744 per contract, which represents a 4.51% amount of time value that's lost by closing the trade. The time value cost to close is 4.51%. It's more than we generated originally when the 165 call option was sold. Way, way, way too expensive. Let's summarize. In most situations, we reserve rolling in-the-money options as we approach contract expiration because that's when the time value component of the option is approaching zero. That's when it's the least expensive to close that in-the-money call. Now, if we find that the time value cost to close approaches zero mid-contract, then it may pay to close our entire position. But in this case, the time value cost to close was a very hefty 4.51%. As I said, way, way too expensive. Now, the question we ask ourselves when we're considering closing a covered call trade mid-contract, can we generate at least 1% more than the time value cost to close by contract expiration? In this case, can we generate at least 5.51% in the next 9 days? And the answer is probably not. Therefore, closing the trade is a no in this particular case because the time value cost to close is way too high. All right, so the Unwind Now tab of the Elite Plus or the Elite version of the Ellman calculator will give us that information and make it easier for us to decide whether or not we want to take this action, or just wait closer to contract expiration and then make our rolling determinations. Now, for a free copy of the basic Ellman calculator, it does not have the Unwind Now tab, but does have the multiple tab for initial trade structuring. Go to our web pages, www.thebluecollarinvestor.com. Click on the free resources link on the top black bar. There's also a put calculator and about 10 other files that are for free. There's also hundreds of journal articles published on the blog link, as well as a free beginner's tutorial for covered call writing and put selling on the top right side of our web pages. Also, you could sign up for our blog, a free newsletter, which comes out every Sunday morning at 10 a.m. Eastern Time. That's on the blog link of our website, and so much more. Now, you can also visit our Blue Collar Investor store, where we have the expanded calculators like the Elite Plus calculator, in addition to online video tutorials, DVD programs, with downloadable workbooks. We have multiple books in the form of ebooks, soft covers, and a few of them also available in hardcover editions. We have a trade planner and online mentoring program as well, all on www.thebluecollarinvestor.com/store. Ladies and gentlemen, thank you very, very much for taking the time to listen to, and in some cases watch, this BCI podcast, number 66, titled Comparing the Cost to Close with Initial Trade Goal for Covered Call Writing. I hope you enjoyed this podcast, but more importantly, I hope it puts some cash in your pockets. As always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.